Well, good afternoon, everyone, and welcome back. My name's Nathan Fabian. I'm the Director of Policy and Research at the PRI, and we're now going to discuss the impact of the financial system on society, and we're going to discuss the role of investors in the financial system. Whether seen through the lens of Wall Street raiders, LIBOR traders, or corporate failures, evidence that the financial system is not working as well as it should is rarely far from view. It's the subject of high politics, of public protest, of economic boom and bust, and of course of Hollywood movies. And not only that, more and more investors are coming to the view that risks and sustainability challenges in the financial system affect their ability to fulfill their duties to clients and to beneficiaries. Now, as part of preparations for our 10-year blueprint on responsible investment, the PRI is conducting a consultation on how best to support a more sustainable financial system. We're looking at the purpose of the system, desirable characteristics for that system, causes and consequences of an unsustainable system, drivers of change that we can expect over the next decade, and importantly, the criteria that we should have as investors in the PRI for choosing where we should conduct our work. Our aim is to identify 5 to 10 policy or industry practice areas that we as investors and the PRI community can influence to support a more resilient financial system and one that better supports sustainable economic development. Now, just like those Hollywood movies, as with any great drama, we need some compelling actors to tell our story. Please let me introduce this afternoon Elsa Boss, the CEO of PGGM, and Elsa is in the role of the investor. Catherine Howarth, Chief Executive of ShareAction, who will take on the role of the voice of civil society. Jennifer Walmsley, Director of Investor Engagement, Financial Reporting Council, in the role of standard setter. And Philip Coggan, Buttonwood columnist, the Economist, who you heard from earlier, and he's going to be in the role of troublemaker. He asked for that role, by the way. So, please, if you would, welcome our guests. Elsa, if I may start with you, we'd like to discuss the context we're operating in with the financial system in society. What do you see as being the purpose of the financial system, and is the system currently fulfilling its role?
Sure. Shall I start with the answer you don't want to hear, and then maybe switch toward the answers that we do want to hear? I think the financial system has 4 core functions. 2 of them supporting the payments between parties and enabling insurance or risk management, if you like. And the other 2 would be store money for future use and the transfer of money from those who have it to those who need it. But given those 4 functions, I think the financial system also has an important role to play in supporting the sustainable development of our economy, economic growth, innovation, job creation, and also to make sure that the system that we have is inclusive and that really everybody can enjoy the system and can use it the way they need to use it.
Those last items you described, would they once have been seen as the role of companies, for example, and investors are in some way some passive operators in the system?
Do you mean the role of economic growth and innovation and sustainable development?
Yes.
Companies obviously play a very big role in those purposes, but this financial system should support that and should make sure that it's there to help the companies to achieve that purpose. The financial system, I think, in itself is not there to be there for itself. It's there for a reason, and it's there to support companies, to support governments, and to support all the players in our economy.
Okay. Some of the players in our economy are, of course, the beneficiaries and the environmental systems and the social systems that the economy relies on. Catherine, how are society's expectations changing around the financial system? What are you seeing in your role at ShareAction?
Well, I think in addition to all the things that we've just heard described, these core functionalities, I think what society expects is a kind of a lightweight, efficient system that performs these functions without extracting too much cost, because collectively we all pay for the financial services system. It's a piece of plumbing that is absolutely essential, but we don't want to pay more for it than we need to, and we have been paying more for it than we need to. So I think part of society's expectation is that we get better value for money from the system. But there's more than that. You know, people they want a system that doesn't facilitate deeply antisocial behaviors. You know, it doesn't facilitate the offshoring of taxes from legitimate tax bases. It doesn't facilitate laundering. I mean, these are all things which in the wider public imagination, the financial system stands accused of. And then I think we get into the fact that, you know, people are beginning, and this is where expectations, I think, are changing and going upwards, that people want a financial system that's cognizant and protective of the underlying natural capital that we all completely depend on in the global economy, and the social and human capital that is an input into the system, you know, creating wealth, but which, you know, in many ways, you know, there are parts of the financial services industry that have seemed to just extract and exploit without giving back and without protecting. So, and people want a financial service system that's populated by institutions that are accountable, that listen to them when it's their money. You know, beneficiaries stick their money in the system, and they expect and hope that people will look after it but they do increasingly expect to be able to ask questions and have them answered. So those are some of the things that I see changing, and I think those are, to be honest, very healthy challenges that, you know, if engaged with, and I think PRI by having this debate is engaging with those questions, lays the ground for the system to be healthy, successful, and to be, you know, a terrific system into the future, which I guess everyone that works in it would like it to be.
Thank you. Jennifer, you've been an investor and you're now in the role of standard setter. Would you care to comment from the standard setter's perspective on the role of the financial system?
Yeah, I mean, I think from our work at the FRC, we see that there are three key priorities really in terms of improving the efficiency of the system. And none of them are particularly rocket science. I would say it's about better transparency, it's about more long-termism, and it's about good stewardship. The FRC, as some of you may know, is responsible for the Stewardship Code and the Corporate Governance Code. What you may not know is that it's also responsible for standards of reporting in the UK. It's a UK-based regulator, but what we've seen over the years is that it has international influence. So if we look at what's happened with the Stewardship Code, started in the UK, we've seen stewardship codes around the world. So although it's a UK-focused independent regulator, it actually has international reach and international influence as well. And just to sort of draw out a little bit on those three areas, I mean, transparency is really around transparency of companies to the market, of fund managers to asset owners. And as the body that's responsible for setting standards around reporting, we are keen to ensure that the right information is being provided to all of those constituents in the chain to enable investors to take good investment decisions, to have information from companies that they can trust, and to enable asset owners to trust the information that they're getting from fund managers, specifically in the area of stewardship. In the PRI report, the relationship between companies and investors is one of the key causes of risk that's identified. And what we really aim to do through a lot of our work at the FRC is to ensure that the information that's provided into the market is trustworthy and transparent, and people can rely on that information. To pick up on long-termism, what we're looking at there is really long-termism around thinking and around actions, which then translates into sustainable long-term growth and productivity. So we've introduced a number of elements into corporate reporting that we think help in this respect. So a key one is the strategic report, in which companies have to talk about the full range of risks that they face, including material ESG risks, and the viability statement, which again is really encouraging companies to look at significant risks over a longer period of time than they have done previously. And we've had some good feedback from investors in terms of the types of conversations that they're now able to have with companies, just really getting that long-term perspective and discussion around key risks. And then good stewardship really goes without saying. This is about good stewardship by investors of the companies in which they invest. One of the things that we've been doing over the last little while, which some of you in the room will be familiar with, is we've actually been looking at the fund managers and the asset owners who have signed up to our stewardship code, and we've been assessing how well they are living up to the obligations of that code. So a bit like the PRI signatory survey, we've been looking at signatories to the stewardship code, and what we will do in the autumn is that we will publicly tier those fund managers. So you will be able to see, okay, is this fund manager a tier 1 signatory? So are they meeting all of the requirements around sort of stewardship? Is that coming through in their reporting, or are they not doing so, and therefore are they rated at a lower level? So all of these issues we think are key to encouraging better practice in the market, and really encouraging and ensuring a more stable financial system, a more efficient financial system, which is in all of our interests.
Jennifer, thanks for that. You used the word stewardship, and I just wonder if I could bounce that back to Elsa, the idea of stewardship. And the FRC has noted the need for more work in this area. How does that relate to your view of the relationship of the financial system and a sustainable economic development?
Well, I think, the role of stewardship and the role that the investors take as asset owners and as owners of companies is a very important one. And there's a lot of opportunity to improve, I think. Not only in terms of how should we behave in our direct relationship with companies, but also in terms of how do we behave in the broader scheme of things. And just to give you an example, I think that it was a scheme from the New York Times that was distributed by the PRI that explained all the different roles of the different actors in the financial system. And one of the important actors, I think, are the sell-side analysts. And if you talk to the CFOs of bigger companies, they do their rounds to explain where they are and to just explain the strategy and the policy of the company. And they meet rooms filled with sell-side analysts that are only interested in the short-term developments that they translate into a sell or a buy or a hold idea, and they never ever ask long-term oriented questions to the people in the companies. And I think we as investors and as long-term investors are just not there. So there are more opportunities, I think, to make sure that we translate the importance of long-term asset holdings into the financial system, and this is one of them.
Okay, very good, thank you. Philip, you've been a critic, analyst and author on the financial system over several decades. How would you characterise the performance of the financial system in society today? How's it going?
So, as we've already heard, two of the key functions of the finance sector are like utilities. So the basic issue is, why do people in the finance sector earn so much? People who work on power stations and repair the sewers don't earn that much. So, and if Thomas Philippon of New York University ran a study which showed that the proportion of income as a percentage of assets over the last century or more taken by the finance sector has barely changed. There's been no net productivity gains to clients over that period. So why is that? Well, I think there are three clear reasons. There's the agent principal problem, which we saw most clearly with the banks in the run-up to 2008. There was a difference in incentives. If you were a bank trader, you had an incentive to take risk with the shareholders' money because you got most of the upside, and the shareholder and then the taxpayer took the losses. The second issue is information asymmetry. If we in this room go out and buy a pension today, it might be 20 or 30 years before we find out whether that's a good product. It's not like going to a restaurant and finding that the meat's off. You have to wait a long time, and in that time, the price is not clear. I interviewed a fund manager only earlier this week who was advertising 0.28% fees on excess fees and across a range of portfolios. And I said, well, what's it on the most aggressive portfolio? And they couldn't tell me. It was only an average. So they weren't telling people the price they were paying for the good. So that, again, is a problem with the system, that you don't know the price and you don't know the efficiency of the product. And then I think the third system, those two things lead to rent seeking. So rent seeking is what economists talk about, is the ability to earn an excess return by exploiting a position. And because the finance sector is so important in the economic outlook, and because central banks will act to rescue the finance sector when it gets in trouble, as they have all the way back to 1987 after Black Monday, then the finance sector gets a sort of easy ride that the central banks will always bail it out if it gets into difficulty. So that creates a culture in which traders assume that asset prices will rise, and we get to the long-term positions we have today when central banks have bought billions of pounds worth of assets and interest rates are at zero. So all those things in combination mean that we have a dysfunctional system, which is both, it is a benefit to society, but it's also the equivalent of a sword of Damocles hanging over us all the time, that we never know when it's going to fall and stab us.
Catherine.
Well, just picking up on this point about the system risk, because I really want to applaud the PRI for taking on this issue of the system, because quite honestly, it was last a kind of issue that people completely grappled with when we had the big financial crisis 2008. And I became a trustee of a large pension scheme in April 2008, and we actually had a board meeting, as it happened, in the middle of the moment when Lehman's fell. And we were sitting there munching our cornflakes. I remember these lovely other trustees that sat on the board, old gents who were real pros on managing financial risk and sitting on a pension fund board, but they were pretty ashen. And I can tell you, I was completely, eager to fulfill my fiduciary duties, was just completely thrown. And it became apparent that, in a sense, individually, our individual pension schemes are kind of quite powerless in the face of the forces that can unleash when the system has a cardiac arrest. And I know that a lot has happened in the regulatory system since then to try and calm things down. And we've got banks having to put more capital behind certain deals and so on. But quite honestly, we're still quite vulnerable. And yet, at the time, 2008, the PRI was a very immature organization. No way could it have brought this, proposed this idea that we address the system risk. But I think, even though a lot of people think, well, thank God we're not facing an imminent crisis, although goodness knows what Brexit would bring. But to try and encourage, you now have, whatever it is, half the assets in the world signed up behind the PRI, to bring that collective strength to try and engage with and think through, how do we manage systemic risk better, and because that is so important to the fiduciary duty, I think, of trustees, is to be engaged, not just with trying to get alpha over everybody else in the marketplace, but trying to keep our system stable, because pension fund members depend on that. So, good for you. I hope all the signatories out there will support the PRI, because it's quite bold. And I'm sure there'll be people thinking, oh God, do we need another flipping, principle? No, but we do. We actually really need this one. So,
okay. All right, well, that's a lot of encouragement, which is very welcome. Thank you. But surely a large portion of our signatory base is going to be thinking, this is the regulator's job. This is not our job. We can't actually fix this, these problems. I heard the words dysfunctional, sword of Damocles, impact of cardiac arrest. Things are sounding pretty bad. So, Jennifer, isn't it the regulator's job to fix this?
Well, at this point, I probably need to put my hands up and say, wrong regulator.
Sure.
We don't regulate the fund management industry, although, we obviously do have close relationships with people in the fund management industry. 300 institutions signed up to the stewardship code. So we know that there are people out there who are engaging with the issue. We also know that if you look at the stewardship code, there clearly aren't 300 fund managers and asset owners who are sort of very serious. This is with investing in the UK, who are sort of fully behind the stewardship code principles and taking a responsible approach to their investments, which is why we've gone down the route of tiering them, of assessing just what those fund managers are doing. And the thinking behind that process of assessing the signatories to the stewardship code is to give some power to the asset owners, because one of the things that we believe is that asset owners have a right to good information. They have a right to know if I put my money with a fund manager that signed up to the stewardship code, are they genuinely doing what they should be doing? So the purpose of the exercise is really to shine a light on that and to give asset owners a bit more, to strengthen their hand a bit more when they're out looking at what fund manager they might choose, when they're having discussions with their fund manager, just to make sure that they've got the information they need to have those types of discussions. Clearly there is much, much more to be done. And I don't think by any means that it's just as simple as saying asset owners need to beat up fund managers more. I think that's a very simplistic, outdated concept. But I think there is a need for greater partnerships between asset owners and fund managers. There's the need for greater engagement for the two sides of the table to really try to understand what each other is looking for. And I think there's a need for the language to change in this space. One of the things that is very obvious to me is that fund managers use a lot of language around investment performance, around fees, around anything else they might be talking about that often is very difficult for asset owners to understand properly. So I think there's a tendency sometimes to hide behind some of that. And again, I think if a light could be shone on that, and I said at the beginning, I think we're the wrong regulator to do this because we don't regulate the industry. That's the FCA in the UK. I think that would just really help to sort of see through some of this lack of value and enable the clients of the fund managers to see, well, where are we getting value and where are we not, and to have those challenging conversations with the knowledge that they do have the facts to be able to do that, and they have facts in a format that they can actually understand.
Jennifer, the type of intervention you mentioned was to provide information. That still leaves a lot on the table.
Absolutely.
So is it your view that investors step up enough to be part of the solutions to these problems or not? And then Elsa, I might come to you and reflect on.
How to answer that? I think there are, I talked about the sort of asset owner fund manager argument, which is very often sort of come back to, asset owners need to do more. We don't think that's the case. I think there are areas where investors could get more involved to make the system work more effectively. I talked about transparency. We're the regulator responsible for the reporting framework. I think there's a lot more investors could do to make sure that the reporting framework of the companies that they're investing in is as good as it can be, that they're getting the information that they need to get. We hear an awful lot of complaints from investors about how companies report. They're missing key bits of information, they're missing key risks, the reporting isn't sort of clear enough. They don't get a fair picture of what's going on within a company in terms of its performance. And yet we don't really hear very much from investors about what they do want. So I think, one of the things I would say is that investors in general, and this is asset owners and fund managers acting on their behalf, do have a duty to get involved in thinking about the framework within which companies report. Ask for the sort of reporting that you want from companies. Ask the regulator, because there are things that we can do. And I know one of the principles looks exactly to this. And yes, you can go out and engage with an individual company to ask them to change what they're doing, but it's just so much more efficient and more effective if you can engage with a regulator and change what companies are doing across the board. So, that would be one of the things that I would really encourage you to do, to think, within the engagement that you're doing, not just about corporate engagement, but also about engagement with policymakers, because we don't hear enough from investors about what they do want from the system.
Thank you. Elsa, should we as investors do more, and where do you think you would work in the system?
I do think we need to do more, and I think one of the key words, at least in this relation, is diversity. For a system to be resilient, you need diversity. And that means not only diversity in terms of the players in the market and their size and their orientation, etc., which I think is important. I mean, we need players that have a short-term orientation to provide liquidity, and we need long-term players. But you also need diversity in terms of the strategy and the approach that individual players take. And you need diversity in terms of the regulatory environment. So I think both need to play a role here. The regulators should think about what kind of regulation is important for what players in the market, instead of, and I think that's where it seems to be going now a little bit, to make that very uniform and very focused on the same elements. But the investors should also think about how they can step away from the approach that we're now all taking. I mean, we all, or most of us, are benchmark huggers. We use the benchmarks. We use the same approach of investing. We step into the markets in the same way, and we do not really, I think enough about what that means and what kind of effects that could have. So the sort of destabilizing effect of using benchmarks and using one theory is a very important element here. So it's both, it's us thinking about how we approach the market and how we design our investment policies and our ideas, but it's also us engaging with the regulators to plea for differentiation in the way they look at us.
Okay, that's very clear. Philip, I'll come to you in a moment, Catherine.
Yeah.
So we've heard a story about regulators and investors working to improve the system. Can the system change from within, or is it so bound in the way it works that it's going to take some external force to really reform and change the system?
Well, I think it probably does need an external force. So let's compare the fund management industry with other sectors. So the index fund was created about 40 years ago, a very low-cost competitor to the traditional business. In the last 10, 20 years, you've seen industries devastated by the emergence of low-cost competitors. Music, newspapers, bookstores have disappeared thanks to Amazon. Travel agents have disappeared thanks to the ability to shop online. But 40 years later, passive managers have 20, 30% of the market. So this is not acting as other markets would act. Again, why is it? Because for a long time there have been conflicts of interest within the system. If you were selling funds, then you had an incentive to sell the active funds because that's how you were paid for them. And the recent pickup in the share of passive funds among portfolios is because of a regulatory change in Britain where the retail distribution review stopped people from paying commission. So the ideas about the greater need for fiduciary responsibility among those people who advise investors and sell funds, that's the kind of change that would alter the industry. But we also have to think about the other fundamental point that Elsa made earlier about what's the point of fund management. And the point of fund management is to allocate capital to the companies which we think will deliver the best returns for society and for investors. And is that actually what's going on in the markets most of the time? When you're a high-frequency trader, you might as well be trading baked beans against peas. Really, you're not selecting on the basis of those company requirements. So if you look at the way that the stock market has changed and fewer new companies are coming to the stock market, more companies are operating outside the public market, particularly in the US and relying on venture capital, there again we seem to have a breakdown in the way that the system is operating. So there again, perhaps there needs an external nudge to change things.
So you sound quite negative actually on the prospects for the system for reform, unless it's going to come through a shock that we didn't ask for, in a way.
Well, I mean, obviously there are potential shocks on the horizon in that asset prices have been pushed up substantially by central bank action, and they've got all the plates still spinning. We've got zero rates and high prices. At some point, you might expect one or two of those plates to fall off, but they'll do a lot to keep things moving. So at that stage, when you have investors suddenly, if you think of if the equivalent of Japan set in the US and the UK, where you had a long period of negative returns, that's the kind of external stimulus that would probably produce reform.
Okay. Now, the one ray of hope you did give us was on fiduciary responsibility. And so I just look to any of our other three panellists. If you'd like to comment on this question of fiduciary responsibility, how far does it go? How far does it get us towards the purpose that Elsa outlined at the start?
I'm happy to say a word or two on this. I mean, I think that the fundamental concept of fiduciary duty is a marvelous one. That somebody entrusted with someone else's assets should apply a high level of due diligence and care, and applying the principles of prudence and loyalty. And this is a terrific concept and hugely needed in our system. But it was kind of absorbed and perverted and turned into this very, very simplistic, our duty is, in a very short time frame, to maximize returns against a benchmark. That's how many people with fiduciary obligations have understood their duties. And that has got us into all kinds of trouble. So what should be and is a really important principle in a complex system with information asymmetries became a real enemy of progress and complex thinking and nuanced thinking and true fiduciary behavior. I think we are, thank goodness, unraveling that. And there's been some fantastic work on fiduciary duty, including by the PRI, including my organisation. I'm very proud of it. And by the Law Commission in the UK, critically. So we're inching towards a world in which true bona fide fiduciary standards are kind of reimagined, and reimagined in a world in which, we're all global investors now. 20 years ago, pension funds in the UK overwhelmingly owned UK stock. Now they're hugely globally diversified, and we've understood this hugely systemic challenge of climate change, which has the capacity to destroy enormous amounts of value in our portfolios. So we're, in a good way, beginning to reimagine fiduciary duty in the real circumstances that we now live in capital markets. And I also think that, going back to the financial crisis of 2008, 2009, we've had a moment which brought home just how fragile the system is. And that's why I think fiduciaries are actually, if you think about it, obliged to take a more system-wide approach and to think about how we protect and help to stabilize this frightening, unstable system in which we all have our retirement assets. I mean, it's a little bit of a scary thought, but that's where we're at, and we need to engage with that.
Okay, well, that's a strong position you've put. Elsa, what do you think about the proposition about fiduciary duty to engage in the system?
Yeah, I think, I agree that fiduciary duty in itself is a very genuine and good principle. But I think we need more room to maneuver and probably also more guts to really think about the content and about what fiduciary duty means and what kind of decisions you need to take to fulfill that. Unfortunately, I agree, and I know that the benchmark is playing a very important role there. But we also know that we've cut the investment chain into different stages, and we have a lot of agents along the chain. And each individual agent needs an assignment, and we want to measure whether that agent has done a proper job, yes or no, which means that we need to measure the added value of everybody in the investment chain. And measuring the added value on a short horizon is much, much easier than measuring an added value on a longer horizon. So I think it's a great concept. We need to treasure it, but there is a huge difficulty and maybe also something that needs to be picked up by the PRI and in the academic network to figure out how we can find ways to measure long-term achievements and to measure what we really mean and what we want to see from a long-term investor. And only if we are able to do something like that, we can hope that we bring some bit of trust back into the system. Because we went from trust me to show me to prove me, not without a reason. And I think this is an important element of it.
Jennifer, do you want to comment on this?
Well, I mean, I would just question whether the concept of fiduciary duty is defined well enough for asset owners to feel confident taking into account the broad range of issues that might have an impact on investment performance. One of the things that we hear from investors is that there is scope to clarify that the work that's been done is helpful, but there's scope to clarify in order to give people confidence that they are allowed to think about the broader range of risks that might impact on their portfolio. I mean, it might be a question you want to ask the audience, to what extent they agree that it's sufficiently clear.
We'll do that in a moment. So get your arms ready. I'd like to ask you, this is a program and an effort that's designed to contribute positive energy to a better system. We've heard about diversity, we've heard about transparency, we may have even heard about fairness without putting words into your mouth, Catherine. But if there was one other thing you wanted to work on in this system, or you thought PRI should work on, what would you choose? And I'll come to each of you on this question. Anyone who's ready, go for it.
I would think it's worth people having a look at the role of some of the other players in the system. I think auditors are quite a key player, and as a representative of the audit profession regulator, perhaps I would say this, but I do think it's really important that you have a right as investors to expect a direct relationship between the audit firms that are looking at the information companies are producing and you as the shareholder. Auditors report to shareholders in theory, or in practice this isn't what happens, they tend to report to companies. But in theory, auditors are there to represent shareholder interests, and they should report directly to shareholders. There's very, very little interest that I see by investors in the whole process of audit, in engaging with the auditors, with audit committees. I think if you were to do that, if you were to think about engaging in that area, it's just another lens, another very important lens on risk and on the types of risk that companies are facing. And I think better shareholder engagement in that area would really sort of turn around the types of conversations that you're able to have about risk. So I would really encourage you to think about the role of the auditor as the guardian of the transparency and the trustworthiness of the information that companies produce, and just think about whether there's something you can do to incorporate audit, which is a very important check of the sincerity of the information that's coming out of companies into your processes.
Very good. We can add that to the long list. Philip, what's one thing we should work on?
I think you should challenge the myth of the all-powerful chief executive. We have a whole system that has been developed to believe that these godlike creatures descend to companies and turn around like Jose Mourinho, an ailing football team. But just in the last 2 or 3 weeks, for those of you not from Britain, we've seen the spectacle of 2 executives appear before Parliament, one Mike Ashley, one Sir Philip Green, to confront problems with their companies and essentially say, I couldn't know what was going on, I didn't agree to this necessarily, you're surprising me with all this, how you expect me to follow this big company. Now, you can't simultaneously say that you're not responsible for everything that goes on in the company and simultaneously demand a very high pay packet to compensate you for your brilliance in running the company. It's one or the other. And I think it's the first. CEOs are not responsible for all the wealth created in the company. They should not be taking as much of the wealth of the company as they do. And you guys can challenge that.
That's about as much rousing applause as we get. That's better. Thanks, everyone. Catherine, I'm going to help you with yours.
Oh, I'll
Don't forget to mention the SDGs.
No,
You said
don't
you
worry.
wanted to-
I would love to.
Okay.
So, I mean, by the way, I would really like to, because I know you've got a checklist of 5 to 10 things you can take on. So definitely take on those two. They were really good.
Okay.
But just in terms of partly to restore trust in the financial system in which many of us are involved, I think it is really important that the financial system engages with the real challenges out there in the real world, the social and environmental challenges, which, you know, the world did come together in September 2015 in the UN to set these 15-year goals. Now, we talk in the investment industry about being long-term thinkers. In the development of the Sustainable Development Goals, investors weren't particularly part of the party. The corporate sector very much was, regulators very much were, obviously governments and civil society. But the reality is, these really ambitious, fabulous goals, which, you know, we'll all be better off in the wealthy world as well as in the poor world if we can achieve these goals, cannot be achieved without allocating capital to solve those problems. This is not just charity, though. It's absolutely in our self-interest because these will unlock growth in a very growth-constrained global economic environment. So I think that again, I really am so pleased that the PRI is consulting right now on whether it should engage with the SDGs as a framework. I think that's absolutely correct. I think millions and millions of people who entrust their savings to this system will benefit from the achievement of the goals and would trust the investment system more if it could see the powerful institutions that make up capital markets playing the part constructively, not in a way that throws the baby out with the bathwater and says bye-bye to good returns, far from it, but is absolutely about playing its role and taking its place in solving the world's challenges. We have a lot of financial power, we have a lot of brain power in this industry, and we should be part of applying them to the tough challenges that we collectively face.
Very good. Elsa?
Yeah, I think too, I mentioned inclusiveness already, so that would be on my list. And the other one I think is the ability to innovate. And then from two perspectives. One is that I think all our thinking is still based on the modern portfolio theory, as Markowitz wrote it down, I think in 1970 or so. It's time for something new. And the other one example would be just look at the developments of the circular economy and what that means for financing companies different from what it means today. That's another example of where I think innovation is needed. And we need new thinking within the system to make sure that not in another 40 years we're still at the same place as where we are today.
Okay. Now, I know we took great care with the questions before we had this panel, but I think we might deviate off script for a minute if that's okay, if you don't mind. So, one challenge you see for investors to get a system where an auditor has a better role, where we challenge the myth of the chief executive, where we work towards the SDGs, we have an inclusive system and an ability to innovate. One challenge that we face as a part of the financial system and one strength we can draw on if we're going to pursue a system that has those characteristics. Take a minute, because I know you'll just jump in whenever you've got something. I can ask the question in a different way. Philip?
I can easily start with a challenge, which is that we have moved into a world of very low interest rates, very low inflation, and thus, in the likelihood of very low nominal returns. And an industry that has built itself on an ad valorem model, taking out a chunk every year, that's going to be a very difficult model to fit into the system. What's the strength I see. I think the strength is there are an awful lot of clever investors. We have seen in recent years that you can break down the skills that investors have shown in picking stocks on value basis or whatever, and convert that into cheap ways of isolating those factors and delivering them to investors at low cost. So you have to keep the skills, you have to keep the ability to find cheap companies, but reduce the cost to reflect the fact that returns to investors in nominal terms are going to be low going forward.
Thank you. Anyone else?
I mean, I would say a challenge is just the fear factor and the reluctance to change. You know, I think there's a huge amount of reluctance to do things differently, to see a model that's been established for hundreds of years, to break that down and to do something very different. There's a lot of fear, there's a lot of vested interest within the system who don't want to see things change in terms of how the fund management industry works today. And I would say the plus point, the positive, is just the level of debate that I see going on, you know, within the PRI, but also in other forum, where investors are getting together and just having a much better conversation about how things need to change. So I think there's a lot more awareness that there is a will to change in some parts of the system. You know, that sort of group just really needs to grow and grow until it can crack the broader system and overcome that fear and reluctance to change.
Thank you.
So a challenge, I think, is that we still have a range of, this isn't going to the quantum point on pay, but inside the investment system, we still have incentives which just drive people to very, very short-term focus. You know, there isn't enough analysis actually of remuneration design in asset management and how that's driving behaviors. I think we obsess about corporate pay and have taken our eye off this. But you know, that is if we're going to take on these systemic issues, if we're going to take on, you know, the wider societal SDG goals, then we need incentives in the system that align with those, and that's a major challenge. On the plus side, I agree with Philip, we've got like brilliant people in this industry. And they're having a very intelligent dialogue. I think this event is a good evidence of that. We've got, in the PRI and in other structures, forums in which people are beginning to do some of the necessary intelligent thinking that will get us out of some of our problems. So I feel encouraged by that.
Thank you, very good. Elsa?
Yeah, I would repeat myself a little bit, but I think that the challenge would be to measure long-term results, to capture the effect of both positive and negative externalities, I think. And the positive for me would be that I think there is much more collaboration within the industry, but also between different parties in the industry to try to tackle this issue and to not only talk about it, but also get into action. So I think we should.
Okay, that's excellent. That's a good primer. All right. I'm going to ask you for questions in a moment, but I'll just quickly let you know that if you want to contribute to this consultation, please go to the PRI website and type the word consultation into our Explore page. And the first link that comes up should be the link through to the consultation documents. We have an online questionnaire where you can give us feedback on whether you think we are addressing the right parts of the financial system, whether we've identified some of the right potential causes of an unsustainable system, and whether or not we're addressing the right characteristics for a better system. So I'd encourage you to go to the PRI website, put the word consultation in the Explore page bar, and that'll take you through the documents. They're about halfway down the page. So, may I ask, any questions in the audience for our panellists, please? There's one right up the back there. Over on the left. We'll take three in a row. So there's one at the back, one here in the second row, and then one over on my far left.
Oh, but I've got three questions. Julian Poulter from the Asset Owners Disclosure Project. One comment on fiduciary duty and one on systemic risk. On fiduciary duty, we have some funds writing to their own beneficiaries. saying the reason why we own Exxon is because we have a fiduciary duty to maximise returns. And we have other funds writing to their own beneficiaries saying the reason we've divested Exxon is because we have a fiduciary duty to maximise returns. So it can mean all things to all people. On the systemic risk side, I think Catherine's absolutely on the money, as she often is, to talk about the last financial crisis. And anyone who's read the Levin, Coggan and FCIC reports will find similarities in some of the systemic risk issues, for example, around climate change, that fund managers and CIOs should be questioning now. For example, everything from why are ratings agencies misrating current debt on high carbon exposed companies, why do fund managers think they'll trade out of the risk, and so on. My question is, what can we do to change the human behaviour that will drive those fund managers and CIOs to question those parts of the system, whether that is PRI, creating initiatives, or other methods?
Good. If we have a microphone for our second questioner. We're not there yet, so we'll answer the question and then we'll move on. So, how do we change the human behaviour? Any takers? All right, so that we'll warm up on that one and we'll take this one as well.
Yeah, I think that's on. Thanks very much. Hugh Whelan, Managing Editor of Responsible Investor magazine. Nothing worse than a question by a journalist for a journalist, but Philip, you described a scenario that a lot of economists, of course, would call a market failure, mentioning Philippon's study about the efficiency of capital markets. And then you sort of seem to suggest that one way of dealing with that would be low-cost active management products. What else do you think needs to actually be done to resolve that euphemistically called market failure? Other people might call it crony capitalism. What actually needs to happen there, in your view? I'm sort of asking you to earn your fee here, if you like, as a journalist, and come up with an answer to what is a sort of blatant
Thank you.
problem.
So you want to kick us off, Philip, or do you want to?
No, it's a very good question. Well, I mean, the costs within the system have come out partly because we have a large range of intermediaries. And I don't know if those of you have read the new book, David Pitt Watson was one of the authors, What They Do With Your Money, I think it's called, but I highly recommend it. I wrote it up in The Economist a couple of weeks ago. Again, the transparency of the system is a problem where it's not clear that all the fees, the cost of all this different layers of intermediary are available to the client. So transparency, which one of the other guests mentioned, is key. The second layer comes not from fund management and the shift from active to passive, but from the banking system itself, and the banking system imposing a high level of costs, which are partly to do with the fact that they have this rent which comes from the fact that they have an implicit/explicit guarantee from the government. So forcing the financial system to have higher capital levels, which has been happening, will in the long run reduce the return on equity, will reduce the bonuses that go to traders and the rest of it, and reduce the net cost to the system. So that's two answers to the question. I think that we would be better off if we paid attention to what Winston Churchill said I think in 1925, after he put Britain on the gold standard mistakenly, when he said, "I would rather see finance less proud and industry more content." Finance is supposed to be a supportive actor for industry. It has taken over the starring role and gotten the George Clooney-like salary, and it really should be the Christopher Biggins type salary. Sorry, probably lost reference on this audience. Trying to think of a minor part player. It really should be the third spear carrier, as it were, rather than the Hollywood star.
Okay, we can grab that one, third spear carrier. Back to Julian's question. People taking different perspectives on the same problem at Exxon. What do we do about human behaviour? Any takers?
Shall I give it a start?
Please.
I would take it from two angles. One would be more the soft side or the cultural side, challenging people to follow their ethical compass and to think beyond law and regulation, but really think about what is important to the fiduciaries that they work for. And the other one would be to think very hard about the incentive structures that we have in place. which I think influence human behavior as well. So, and if the two can go together, I hope that in the end we will get people to do the things that are right rather than follow the textbooks or the regulation.
Thank you, Elsa. Question over here, if we have a microphone ready. Thank you. And please stick your hand up now if you're the next.
Hello, it's Kaori Shigeya from Oxfam. I believe that one of the reasons that the financial system has failed is due to the US and UK's emphasis on shareholder capitalism, which worked to the detriment of other stakeholders. And I think recently I read some figures that over the last 30 years or so, the value that's being extracted to the shareholders have grown by 70%. And so my question is this: so in order to change the system, how do you persuade investors who actually have benefited from this shareholder capitalism?
Let me see. Who wants to?
Yeah, I think, I'm currently in a group that is working on rewriting the corporate governance codes in the Netherlands. And one of the things that we've debated there is that the thinking about the multi-stakeholder purpose or focus should not only be of interest to the company, but also to the owners of the company. So it's I think, promoting the multi-stakeholder perspective into corporate governance codes that could be of help here.
Any additions to that?
I mean, I would say it's very difficult. When we look at corporate reporting, we do currently look at it from the perspective of an investor in the company. When we're thinking about, what should go into a company's report, I think once you go down the route of saying actually it should be a stakeholder report, and I wasn't completely clear on what your question was, so I may be answering a different question. But what I would say is that once you go down the stakeholder route, then reporting just becomes, it's got a tendency to become unmanageable. We have somebody whose pretty much full-time job it is to resist attempts to add things in to annual reports of companies in the UK. And I think that just sort of illustrates the fact that there are a huge number of interest groups, of NGOs, of other types of stakeholders who would like to get certain pieces of information out of companies. To date, we've stuck to the line that actually an annual report at least is for investors in the company. There are other legitimate stakeholders, and our position has been so far that information for other stakeholders goes outside of the annual report, because otherwise you start to lose the clarity and the conciseness of that report and that information. If that's not your question, please come in. I can see you shaking your head, but I'm very happy to chat afterwards if you think there's something more useful I might be able to say.
So this is such a big topic, but we have seen this kind of historic rise of the shareholder and a big extraction of value by shareholders, as a share of value over labour. But we've also seen at the same time a huge historic rise in the importance of the institutional investor. I mean, our stock market used to be dominated by individual shareholders. It's now totally dominated by institutional investors who represent all the stakeholders, and yet we don't necessarily see, except we're beginning to through the PRI. This is sort of, in a way, the concept of responsible investment. It's trying to kind of represent a fairer view of the interests represented by those large institutional investors. And you couldn't see a better example than pensions automatic enrolment. Now everyone in Britain, obviously with it not true in every country, but and I know there are many people in the audience from different countries here, but everyone now in Britain is a shareholder through their pension funds. And yet we see institutional investors sometimes chipping away at, employee benefits and nudging companies to take quite short-term perspective sometimes on those things. So what we kind of need to have is a slightly more balanced picture. And for that, I think we do need to have an era in which beneficiaries of pension schemes and other stakeholders can have a bit more of a voice in the system. And I do think that's part of we have quite a good system of corporate governance. We don't have a particularly strong system of investor governance where we have AGMs for companies, but we don't have pension funds where people can go and ask a question of their trustees about whether how they're looking after their best interests. And so I think we actually do need quite an interesting reform agenda around investor governance, which would help to create a better balance of powers and a better balance of outcomes in the end.
Okay, thanks, Catherine. Forgive me, we might have to pause there on the questions because we are running out of time. I'd like to give our panellists the option of a final 30-second comment. And Catherine, we might take that as yours unless you really want another one.
Yeah, that's fine.
Is that all right?
Had mine.
That was a good sum up. So, final comment from anyone else? If you wish. Don't need to?
No.
That's fine, your prerogative.
Well done.
Okay, so we would encourage you to work with us as we try to pursue positive characteristics of the system we want and to address some of the barriers or the challenges to a sustainable system. And once again, you can start by giving us your feedback through this consultation process so that we can incorporate this work into our 10-year blueprint for responsible investment. If you would please, thank our very generous and able panellists.